It looks like AMC stock has finally found a bottom, and there's a lot of data to support this, and that's what I want to get into here in this video. This is not going to be one of those opinion-based videos. This is all factual. Why I am making these claims is very important. Hopefully it makes you guys some money, and we are going to talk about options in this video as well, because I like the idea a lot of buying options today to hold over the weekend for the next couple of weeks, maybe the next couple of months. But keep in mind, as I make these options trades or talk about these option trades, really ever, not financial advice. Just know, if you trade options, you will likely lose all of your money, if not a majority of your money, as you guys probably do know. But if you like to trade options like I do and you see the potential, you know the risk involved, welcome to the channel. You are also a degenerate gambler, just like myself. Now, let's get into exactly what is going on today, why I am making these claims about potentially seeing an AMC bottom here today, and what the news is, why stocks like AMC, really your consumer discretionary stocks, are down so much more than other stocks today, like healthcare, like consumer staples, like Walmart, Kroger's, those stocks. Kraft Heinz doing very well today. Let's talk about it, guys. We got a lot to get into. Hit the like button and subscribe to the channel. Those are the two best things that you guys can do right now to help out the community and bring new members in and give them at least an honest, accurate due diligence video. As well as that, if you guys want to go the extra mile, comment down below. Let me know your thoughts on this video. When do you think the bottom is going to be in for AMC stock? Nonetheless, let's get into it. So AMC is down about 3.93% currently, sitting at $18.95 per share. Let's briefly talk about the news for the day, and then let's talk about exactly why I think AMC stock has bottomed. And that's going to be very important, and I hope you guys do find some value or perspective out of that. But the markets are down quite substantially today, at least in the Nasdaq, in the tech sector, down about 0.70%. Russell 2000 up 0.17%, but look at the Dow Jones, up 0.69%. So you got a lot of oil up today, you got a lot of natural gas up today, commodities are up as well today, and pharmaceutical stocks, consumer staples, things people cannot live without. When you hear of consumer staples in general, when you hear that word, not like the business staples, but consumer staples, they're things you cannot live without. You guys cannot live without going to Kroger's, Costco, right? Walmart, these places you have to go to. So during times of uncertainty in the markets, during times of being on the verge of a recession, a lot of people flood their money into these stocks because they will do well regardless of what happens. Healthcare, same way. When are you going to go without your prescription that you need? It's not going to happen, right? So that's why you're seeing weakness in the tech sector, and you are seeing staples doing better today. But the actual news here, it says, as inflation bites and America's mood darkens, higher income consumers are cutting back. And it does say key points. American consumers are already cutting back on spending, according to a new CNBC survey. For many living paycheck to paycheck, this is not a surprise as inflation rises and COVID stimulus savings decline. However, the survey also shows that higher income consumers are showing signs of financial stress and have begun cutting back on dining out, travel, vacations, and cars. And it also goes on to say, fun fact, that about 60% of U.S. consumers living paycheck to paycheck is not a surprise to see that spending cutbacks have started. So, you know, if you got a long-term portfolio, you're probably not in that camp. So congratulations, you're already doing better than most people. But that's just an unfortunate data point and statistic right there, nonetheless. But that's why a lot of tech stocks, a lot of your stocks that people don't need, are not doing as well today, and AMC falls perfectly in that camp. You don't have to go see a movie. You don't have to do things like that. So if people are starting to cut back on spending, or even if they're not, if investors are thinking they are, you know, AMC is not really a stock that's going to benefit from that. But even on a day where really the sentiment around a lot of these consumer discretionary stocks, discretionary income, right? They're not doing so good today. AMC is not down as much as it could be, right? We always say that. But AMC falling again, 4.5%, taking another move down. Definitely not a good thing to see for your portfolio. But look, we're riding this 50-day moving average. We are right here at this level. We have actually found support at this twice. Once today, right at this level, $18.40 per share, as well as yesterday, that was about $18.60 per share. So finding a lot of support and a lot of demand once you get close to that 50-day moving average. And look up here, right? This was your previous resistance level to a certain extent. Well, $21, but this was the key level. You touched it back here, and then you finally broke out, right? So let me go over what I do as far as trading, and sometimes how I flip SPY options. And it comes down to the moving averages and key levels like we're at right now. 1850 has been a key level for a long time, as well as that is where a 50-day moving average is, right? So you tend to see a lot of resistance around 50-day moving averages or support. Once you finally break support, like right here, you end up falling under that substantially. But odds are about 8 out of 10 times when you are actually coming and testing a level over and over again and finding stability and finding demand and support, you tend to continue to rally off. Well, you tend to rally off of that, right? So if you guys are into candles, then you probably already know this. But if you get wicks that are like this on a key level multiple times, and this is not an example, but key levels of wicks at like 445 on the SPY or 450 on the SPY, there's not really a good example to point out right here, right now, because there's not too many crazy wicks to the upside today. But if you get that multiple times, or that to the downside as well, these wicks down, right? And then retracements back up, which I would imagine that's going to happen by the end of the day. Maybe I'm assuming a little bit right there. There's a little bit of a wick on this candle already. But you get these wicks down, the lows of the day, and then you recover, and you're coming down and testing this support. Any support level, really, in this case, 50-day moving average, that tends to be a sign of strength, and that is usually where the trend does reverse if you're thinking about a support level. So it looks like the stock probably going to make a move back up next week, possibly by the end of the day today. Doesn't look as likely, but as long as we remain above the 50-day moving average, and the further we get away from that, is going to be even more confirmation of this rally, or at least that the bottom is in for next week. Now, it's very, very important. Pay attention to key levels as well as moving averages. As you guys can see, just look at the SPY just briefly, right? We never even broke above the 50-day moving average in the morning. We finally broke above it a little bit, found resistance, and then we finally did break above it again, and that becomes your support level. Then you start riding the support in here. Right here, you touch the 50-day again, and then you touch the 50-day a couple times up here, and then you finally just broke under that. But what kind of candle did you see? A big ass candle, right? You come down, test the low, and then you get that break. So you usually get the break pretty quickly if you're thinking about moving averages. If you don't, it tends to be support as well. Like, look, resistance right after you broke that, resistance, touch that 4 or 5 times, and then you finally just got a big break above that. So odds are, in my personal opinion, AMC is going to see a bigger move to the upside now that we are retesting this 50-day moving average. If unfortunate events happen, if something crazy happens in Russia or Ukraine, I mean, there was a headline that Putin might turn to weapons of mass destruction if they start to feel like they're going to lose the war. I mean, that's going to affect the markets. Things like that you just can't really control, and technicals don't account for that, right? If a nuke went off for a chemical weapon, markets are probably going to drop dramatically, and there's going to be no saving AMC as far as the 50-day moving average. So if we do break under that for whatever reason, $15 is going to be that key level. I don't think you're going back down to $12.90 or breaking these lows especially, and that's why I kind of find it comical that people are talking about buying puts on AMC stock. As you guys know, a stock can go up to infinity. A stock can only fall so much. AMC premiums are way too high, in my personal opinion. They can make for nice day trades, which I have day traded puts before. You know, I'm a degenerate gambler. I like to make money wherever money is to be made. But, you know, buying puts and holding them on AMC, probably not a good idea when you've already fallen so much. Like, every day has been a substantial red day. Today, 4.5% red. Yesterday, 3%. Day before that, 4%, 9%, flat, 5%, 4%, 13%, and another flat day. So we have really not seen a green day in a substantial way, more than 0.5% in the last 2 weeks of trading almost, right? 1, 2, 3, 4, 5, 6, 7, 8, 9 trading days now. Almost 2 trading weeks. So we're definitely due for a big green day. And we have seen the volume come down, and believe it or not, we're actually holding up decently, right? We were under 1850 for a while. Even going back to mid-February, we were at about $18, right? 1850. So we've actually held up a lot. We need to see the volume head back into the stock, and that's also a guessing game. Is that going to happen next week? I don't know. It seems very logical that it would, considering the stock has fallen so much. And keep in mind, this is not a penny stock that has no business behind it. There is a business behind AMC, obviously. You've been to the theaters before, and it's recovering. It's getting back to normal. The profit margins are going to be better than ever. They have so many new initiatives that they're doing. It's going to be very, very good. Nonetheless, that is really my thesis on why we are going to see a bounce for AMC stock. I don't think next week is going to be a continuous slide to the downside. That's why it looks like to me now is a pretty damn good time to buy some options. And if I were, to do, buy options on AMC right now, I'm probably going out to May 20th because I want time. And if you could get a $30 call for May 20th for 155, that's not too crazy. We could head back up to those levels, or at least you can make money on those options fairly easily. But obviously that's not financial advice. That's kind of just what I'm looking at, and kind of where we could bounce. We could see another big green day once the next catalyst comes out. As you guys do know, Adam Aron and his team are looking at investments to buy right now. They have been every single day as we speak, as we make these videos. They're actively working on that, and that's going to be the next big catalyst. As far as the Ortex data, you're looking at short interest of free float at 20.69%. So shorts are indeed not covering yet again today. They don't slowly cover on their short positions. They don't cover on their short positions when the stock goes up. They short the stock instead. It's just facts here. It's facts. Shorts have not covered. 106.66 million shares that are sold short. Cost bar max of 2.73%. Utilization of 100%, and days cover at 2.41. So the data here looking pretty damn good in my personal opinion. Considering what we have seen, even with this rally, this almost 200% rally, shorts did not cover anything. The short interest actually climbed the whole time. So they're not covering. Data's looking really, really good for this bounce that I'm even talking about here, but for the MOAS in general. You have 5 orders for the day, option orders totaling $1.23 million, positive order value of 0%. A lot of these April 14th puts that are coming through, and hedge funds, they're just as clueless as other people that tell you to buy puts on AMC. Like, they lose almost every time. They're buying far out the money puts that have high premiums. The break evens on those are ridiculous. Like there's no sense in buying puts on AMC, in my personal opinion. Regardless of who feels like it hurts the movement or not, it doesn't make sense from a trading aspect. I would much rather right now buy calls in AMC than buy puts. Now the max pain is $21 per share by the end of the day today. That's obviously not going to happen, or at least it looks very unlikely. The max pain for next week is also $21 per share. We don't have any data that is coming out. We do have the agriculture report, the stockpile report. It is this in here, WASDE report, that is coming out in about 6 minutes from now. So that's definitely going to move the market by the time you guys see this video. It could have a bigger impact than not, or it might be a smaller impact, but the way the market feels about commodities and inflation, how that ties into a potential food crisis, it's going to be very important in my personal opinion. Now, as far as the Fed rate monitor tool, the markets are pricing in 3 back-to-back 50 basis point rate hikes for the next 3 meetings. And as the markets do rally, it's like people are fighting the Fed. The Fed is bearish. the markets want to be bullish, which is fine. That's all fine and dandy. But have you ever heard the term "don't fight the Fed"? I'm sure you guys have heard that. People in 2020 and 2021 that were bearish on the markets were fighting the Fed. You didn't want to do that. You lost money if you did that, right? If you were buying puts, short in stocks in 2020, 2021, you did pretty damn bad. If you bought stocks, you did good because you weren't fighting the Fed. Now the Fed is reducing accommodation. They are becoming more hawkish on the economy, raising interest rates, the cost of capital, and people want to be bullish. You're fighting the Fed. I would just say, be careful here with that. Keep extra cash on the sidelines. Interest rates are likely to not be raised in 0.25% increments after they do a 50 basis point rate hike, because as the markets go up, the Fed says, hey, the markets can withstand, a bunch of rate hikes, 50 basis points every single time. So, keep that in mind. You're likely to see it get a lot worse before it ultimately does get better. Yeah, and that's 3. And then, 4, yeah, they're just pricing in 50 basis point rate hikes across the board now. Look at that. Wow, they're pricing in 1, 2, 3, 4, 5, 6 50 basis point rate hikes back to back. That is crazy. That is crazy. And then holy shit. And then for February, you finally see the odds actually change around a little bit. But oh my God, that's bad, guys. That is not good. My daughter's just going crazy over here. So that's pretty much going to wrap up this video. As far as other technical factors that you probably want to know, the RSI is sitting at 45.71, so a little bit on the oversold side. The MACD is also in bearish territory. And just watch that 50-day moving average. Watch to see if we can break out above 21 by the end of the day today. Doesn't look very likely. Anything's possible in this day and age. If we can even retrace back up over 19 to 1950, that's going to be a very, very positive thing. But that's going to be all for this video. Hit the like button, subscribe to the channel, do what you guys got to do. I'm going to get out of here. You guys enjoy the rest of your day, and I'll see you in the next one.